Nebius Group is one of the most volatile AI infrastructure stocks in the market right now. Huge upside potential, massive capital requirements, and a valuation that has sent investors on a roller coaster ride. So, today I want to answer one simple question. After everything we now know, is Nebius Group still a buy, or has the risk started to outweigh the reward? Let's break this down. Nebius Group is focused on building AI optimized data centers for enterprises, not generic cloud infrastructure, not traditional hosting. This is purpose built computing designed specifically for artificial intelligence workloads, and that distinction matters because AI demand today is not incremental, it's exponential. One of the biggest validation points for Nebius was its multi year, multi billion dollar agreement with Microsoft. That deal put Nebius on the map, not because Microsoft magically makes Nebius profitable overnight, but because it gives the company credibility, visibility, and access to capital, and capital is everything in this business. Now, the stock itself has been extremely volatile. Valuations surged earlier this year, then they collapsed, and yet, despite all of that, the stock is still up significantly in 2025. Why? Because the underlying business is showing real momentum. At a recent investor conference, management shared something very important. Nebius reported roughly 70% quarter over quarter acceleration in its pipeline. That translated into about $4 billion in remaining performance obligations in a single quarter. In simple terms, future orders are piling up faster than the company can currently deliver. Demand is exceeding supply, and this is not unique to Nebius. We've heard the same story across the AI ecosystem. Compute demand is outstripping availability, and Nebius is investing aggressively to close that gap. Now, here's the main concern investors have. What if Nebius is building too much infrastructure? What if once these contracts are fulfilled, demand slows down and the company is left holding excess capacity? That's the bear case. But management pushed back on that concern with the key insight: AI workloads are evolving rapidly. This is no longer just text based AI, we're moving into voice, image, and video based AI. And those modalities require dramatically more compute, video responses, audio generation, multimodal models. All of that multiplies computing requirements. So, even if AI adoption doesn't accelerate further, compute intensity per user is still rising. That's a crucial point. Another criticism of Nebius is that it's just renting GPUs, in other words, a commodity business with low margins. Management strongly disagrees with that framing. Nebius is not trying to be GPU as a service, they're trying to build an AI hyperscaler. That means a full stack approach: workload orchestration, virtualization, control planes, security, data development tools, operational software. The goal is to bundle services around compute, and if they succeed, margins look very different from simple GPU rental. Yes, GPUs come from nvidia, but value is created in how those GPUs are deployed, optimized, and managed at scale. Now let's talk about the Microsoft deal, because this is where investors need to think one level deeper. When a small company signs a deal with a massive company like Microsoft, it looks incredible on the surface, and Nebius absolutely uses that deal to attract investors and lenders. That's normal. But here's the reality: large companies have all the negotiating power. Microsoft knows that Nebius benefits enormously from being able to say, we have Microsoft as a customer. That leverage almost always results in very tight margins for the smaller company, sometimes even losses on the initial contract. We've seen this movie before: Rivian with Amazon, Symbiotic with Walmart. The partnership creates validation but not necessarily profits. So when I say I like Nebius, it's not because of near term profits from Microsoft, it's because that deal unlocks capital. Banks are more willing to lend, bondholders are more comfortable, investors see lower counterparty risk. That allows Nebius to build infrastructure knowing demand exists, and that matters. Now let's talk profitability. Management expects the core business to have turned EBITDA positive in Q2. They also expect the entire group to reach EBITDA break even by year end. That's a meaningful milestone. Longer term, management is targeting 20% to 30% operating margins. That's driven by scale, operating leverage, and proprietary infrastructure. They're also using a conservative 4-year depreciation schedule for Hopper chips. In other words, they're assuming the hardware becomes obsolete faster than some peers assume. That's conservative accounting. Now let's talk valuation. Using my discounted cash flow framework, I estimate fair value around $110 per share. The stock is trading around $90. Even after applying a margin of safety, and even after the stock jumped recently, it still looks undervalued on my model, but I need to be very clear, this is a high risk stock. This belongs in the same category as early stage quantum computing and frontier AI infrastructure plays. Execution risk is high, capital intensity is high, volatility will be extreme. This is not a stock for conservative investors, but for investors with a high risk tolerance, the upside is compelling relative to the risk. So where do I stand? I'm maintaining my buy rating on Nebius group at current prices, not because it's safe, not because it's predictable, but because the risk reward still makes sense for the right type of investor. This is a bet on AI infrastructure demand continuing to grow, and Nebius executing well enough to capture a meaningful slice of that demand. As always, this is not financial advice. Do your own research, understand your risk tolerance, and most importantly, don't confuse volatility with fundamentals. If you found this analysis useful, let me know in the comments. I'll see you in the next one.